Welcome everybody, and great to be with you. It's David back for one of the final videos. We have reached study session 15, the very last reading, which is reading 36. Almost at the very end of the whole curriculum. The only one to follow are the case studies, so we're almost towards the very end. And this reading is trading, performance evaluation. It's the manager selection part of all this here. Now, compared to some of the other readings, this is much more of a straightforward one. It's been in the syllabus for some time, but it's had a bit of a makeover, so let's have a look at it here. Now, you might be wondering why I've put the famous Bernie Madoff at the start of our slide pack. That's quite a context for what's going to be in this content, because in terms of evaluating a new manager, selecting from a wide universe of managers, you want to avoid that Bernie Madoff problem. And when I was reading this section for the first time, it made me consider the Bernie Madoff problem. That how would you spot, for example, some of the issues shown by the Madoff case? For example, the strategy. Now, Bernie Madoff's strategy was too good to be true. It was too consistent. And it was challenged by a number of people. They said, well, you can't get that consistent returns with that level of risk. It just can't be done. Something's fake about it. Also, when you think about Bernie Madoff had no other independent professionals involved at all. He was very much controlling all the information himself. There were no independent trustees, for example, or holders of the assets or depositories, anything like that. He was in full control. There was no independent way of checking anything as well. And also, for example, the accountant or the auditor was very much a small someone that's not widely known. Very unusual to have that kind of person acting in this kind of high-profile case. So what we're saying here is the due diligence is the main theme of the chapter, and hopefully to avoid being caught out in a Bernie Madoff scenario. Let's have a look at the main ideas here. So compared to some of the numbers readings, this is much more of a discussion. However, there are a couple of calcs that you have already seen, like capture ratios, coming up very shortly. So it's mostly going to be a tour, a discussion, some of the areas pretty friendly, I would say. Now, there's a bit of theory to refresh. Returns-based and holdings-based style analysis, they have been mentioned in a few places, like in the equity area and in the evaluation area. So I'm going to refresh those a bit as we go through as well. Now, in CFA level 1 and 2, I'm sure you recall some of the type 1 and type 2 theory. They're back once more, but the context has changed. We're going to have a look at this in the idea of manager skill. Going to do a hypothesis test. Does the manager have skill? If we correctly assess the test, we can avoid these errors. But of course, working with data is quite likely we can make some mistakes. So we're going to have a look at type 1 and type 2 errors in our interpretation of these tests. Now, new in level 3, capture ratios. They are relatively new, came in 2020, but they do appear in the evaluation chapter, and they appear here as well. So although it is primarily a wordy chapter, I guess potentially the two areas where there could be a calc, I would say, would be perhaps to calculate a capture ratio coming up, and also to work out a fee as well. Some interesting ideas coming up about different fee structures. More of those calcs coming up a bit later on, but the main focus is going to be more of a wordy tour through the ideas. All right, so here's the task ahead. How do you evaluate, how do you choose members of your fund management team? How do you bring in a manager? It may be that it's one of many. I always think of a sporting team here, whether you want to have a football team or you want to have your own sporting team. Is it a defense selection you want to make? Is it more of an offense? What's the role of this manager coming in? Are you replacing someone? Are you expanding your approach in this way? Now, the scope of what we should look at here is very wide, and I'm not just thinking about in terms of performance data. We're going to have a look at it from a number of different angles here. When you think about the ultimate decision, they talk a bit about market efficiencies here. What's the main scope for alpha? Where's it going to come from? Where's the kind of new information? Where's the scope there to add some value, if you like? Is it going to be an individual? Is it going to be a whole investment team you're looking to secure? Yeah, looking beyond the numbers, when you think about, for example, hedge fund due diligence, could be a part of the world with less regulation. Could also be a lot more in terms of the ownership of the firm, thinking about the integrity of the firm, not just the numbers themselves. And that's why it's not just a quant exercise, it's quite a lot of the other background due diligence as well too. Okay, so one of the interesting things to me, I'm a risk person, I work a lot in risk, and when I review claims in terms of future performance, as you are as level 3 candidates as well, when it talks about here the likelihood that they can repeatedly earn sufficient or better returns in the future, we know that that's quite a claim. That phrase, past performance, is no indication of future performance. We know that it would be wonderful if there was a cast iron way to guarantee that, and of course there isn't. So when we look at their past performance, we want to understand as much as possible how they got there, in terms of the strategy, in terms of their process, the team. Will it be likely that will work in the future? How much of it was skill? How much of it was luck? And so in the past, what you might have thought was skill or alpha, how much of that is outperformance due to their skill? Maybe the more we look into it, we can say, well, part of that perhaps was just pure market performance. There wasn't really a lot that they did. Perhaps it was down to a bit of good or bad luck coming in as well. So I think the trend in recent years has been that what we used to think was added value in terms of skill may be a lot more easy for us to recreate passively now too. So the three components we're going to have a look at here. Number one, starting with quite a broad universe of possible managers. Let's try and narrow that down using the mixture really of the numbers and the more the wordy parts here, the due diligence. Let's try and narrow that down into a workable team to choose from. Now, let's bring in the starting point of many of the investment process, the client's investment policy statement, of course. Not all managers will fit. If they are far more cautious, for example, perhaps going down the hedge fund route and bringing in a hedge fund manager might not fit perhaps that well. So, but bringing in someone that fits in terms of a good style fit, passive, semi-active and active, also bringing in the right kind of manager, geographic location as well, and investment style too. So there's an awful lot coming in about checking out and verifying the manager's actual style. Is it growth or value? Is it momentum? What kind of a manager are we looking for? Yeah, they talk about here different styles like the large cap, mid cap or small cap, perhaps even more like the venture cap as well, bringing in the right kind of person. So from a sporting analogy once more, if you are looking for a striker, are you looking for a midfielder? Are you looking for a defense here? What do you need as far as the team? So this idea of having a broad universe initially is discussed. And a lot of the slides talk about the questions and the due diligence you might want to start to ask here. They talk a bit about some risks involved though here. One, if you are too broad, in your focus, well, it's going to take you a lot of time and effort, and do you have the capacity to evaluate all these managers? But if you're on the same way, if you're too narrow in your focus, well, perhaps you're missing out on some very useful managers too. So it's as far as setting some key objectives as to what you want from this search, but starting to eliminate and to narrow them down. Now, what's the reason we are bringing in some new people? Are you replacing somebody? Are you expanding your strategy into something you haven't done before? Is it in line with your new strategy that you might have? So maybe it's a strategic asset allocation, a long-term plan you have, or is it more of a tactical asset allocation? Is it more of a tactical short-term view? Now, one of the slides that follow in this next section talk a lot about benchmarking, and what they're talking about here is how can we better understand or categorize the style that we're looking for. Well, are we looking for a growth manager, a value manager, a geographic location? Are you looking for someone to add some specific skill perhaps that we don't currently have? And how are you going to measure the manager's skills at that style? Well, here we want to benchmark them to something. Maybe you have a style index, and we have a couple of techniques from other parts of level 3 to revisit, guys, here. The returns-based analysis, lots of focus coming in on this one, and also the holdings-based as well. So let's have a look at these two in a bit more detail. Before we get to the numbers, though, they're just cautioning us, let's start off away from the data and think more about big picture. They mentioned about the IPS, guys, the investor policy statement. Key things they're looking at here, I guess, are the overall kind of style of the returns and also the risk. Does the risk profile of that manager fit the client's risk profile and our risk profile as well? Yes, so there you go, trying to make sure, for example here, imagine if you looking a bit too much perhaps down the hedge fund route, that might not fit at all well with the kind of client's risk profile that we're thinking of here. So the two aspects are coming in, the first one being the quant side of things. And it is interesting whenever they talk about the past. Now, link into other parts of level 3, guys, here from your studies. This slide pack does bring in some of the potential dangers or pitfalls, like the behavioral biases. You might, for example, link into a representative bias where you believe good companies from the past or good managers from the past must mean a good manager in the future. So the slides just have some cautionary tales not to get perhaps too linked into past returns, thinking they're going to repeat all the time. Was their return partly down to skill? How much of it can we allocate and attribute to skill? But did they also have a bit of good or bad luck along the way as well? So for many years, the CFA syllabus has never ventured into the area of luck. It's quite a controversial area, but for the first time in 2020, in the evaluation area, they do go here, which is quite interesting. Now, the two calculations, here's a quick mention of one that's coming up that you have seen in the evaluation chapter, which is the capture ratio. Capture ratios we're going to see look at the performance of a manager in an up market, and also look at the performance of the manager in a down market, in each case compared to the broad benchmark or market here. Now, a manager that demonstrates skill, of course, would hopefully do better in an up market than the benchmark, would have more of an up, if you like, and in a downward market would hopefully have less of a fall. So that idea of skill, looking at their ability to add value or alpha, more of an up and less of a down. And as we know, that kind of idea has more of a convex type payoff, that convexity idea you've seen before as well. Now, drawdowns are drops from a high point to a low point, that they're very, very favoured in the hedge fund and alternative world because clients understand them. You think about drops are quite intuitively bad, of course, so the idea of measuring daily drawdowns, monthly drawdowns, even you might measure a maximum drawdown, that's quite a useful technique. The drawdowns are coming up a bit more detail as we follow through. Again, from a risk perspective, we're talking about likelihood and probabilities. What's the probability of likelihood the same level of returns will continue? Well, we know there's a bit of a question mark there. Who knows, in terms of that. I guess track records are going to help, looking at the processes, looking at their future estimates and ideas coming in through. But to be fair, all these things, we can't guarantee the future, of course. What's much more practical instead is to review how they do it. Will the process remain consistent? Will the people remain consistent too? What are the likely areas looking ahead where we can add some value here? Now, when it comes to risks, the chapter does look at a number coming in here. One of the ones that's particularly that comes forward is liquidity risk. When you think about the major risk areas, like, for example, market risk or credit risk or operational risk, all of these are valid, of course, for all in your due diligence, especially, for example, operational risk, where you might have a very small team in a part of the world with little regulation. Perhaps it's different from your home base, your home regulatory regime. And of course, liquidity risk is often known as the forgotten risk, particularly in the last crisis. Whenever you see quotes of 10 days, yes, I think we can liquidate in 10 days. That was the old norm for many years. And that often indicates that in a crisis period, there's no way you could liquidate in 10 days. Those of you who work in this area might know a bit more about Basel III, one of the recent changes in this area to market risk, where rather than rely on the 10 days in real life, 10 days, 20 days, 60 days, 120 days and 250 days. So in real life, the focus allows a much broader assumption about liquidity depending upon the asset you're investing in. So a bit of a worry if you're relying upon being able to get your money out in such a quick 10-day period. You might not be able to in a crisis period. The 4 Ps are coming in here, back to our qualitative review here. And remember that the slides that are coming in here are all about questions. These are questions you want to ask your managers that you're starting to whittle down a bit more. And one of the first questions you might want to ask, say we're talking to Bernie Madoff once more here. Okay, then Bernie, tell me about your investment philosophy. Where do you receive your returns and added value coming from? Can you explain the strategy? Can you explain how it's going to work? Now, of course, Bernie in real life didn't want to explain any of that, so he avoided these questions completely. He didn't want to have to explain it was all made up, of course, but you would expect any decent manager to be able to talk through, be able to detail their investment outlook and plans. One of the things this chapter talks a lot about are inefficiencies. To make alpha, to make profits, to make excess returns, there has to be some form of inefficiency that you can exploit. What is your view? Where are you going to get it from? What's your view about moving ahead? How will that change and evolve over time? Do you see this changing? Now, one of the things we've seen in level 3 is that you won't be the only person that spots this. When there's this potential source of alpha, others will see it too, and that will start to decay and diminish over time as other people start to copy it. What processes are you going to use to capture these inefficiencies? What kind of processes are you going to use here? What's your plan to implement? When we talk about, by the way, implementation and processes, I often think about a surgeon. When you think about a surgical operation where such a precise area. One small error or human error or mistake, getting it wrong, could be life and death in that situation. And often from a complexity perspective, especially with investment strategies, it can be like that as well, especially when you think about more down the hedge fund route as well. So a small error when you implement a strategy could be disastrous too. The people involved in terms of experience and the wider team involved, the support staff, guys, all that kind of thing is very important too. And then the overall portfolio construction techniques coming in as well too. Now, when we talk about any portfolio, we know the review aspect of monitoring, even the IPS as well, of course, the policy statement being monitored normally at least once a year anyway. Okay, on to one of the main, I think, quite testable parts, a little bit more technical this time round, and it's a link to some other parts of CFA you've seen before here. We're going to do a hypothesis test. We didn't expect to get a hypothesis test as part of level 3 right towards the very end, but we have one here. And the hypothesis, guys, we're saying here is that the null hypothesis is they're not able to add any value. So in a way, they're not able to add any extra skill or value in terms of being a manager. And then the alternative is that they are able to add value. Now, with a type 1 error is always when you reject. So if you reject the null, you are saying here, yep, you do believe they can add some value, but guys, you're rejecting that in error. So a type 1 error here, you've rejected the null in error. And then with a type 2 error here, you have failed to reject. Guys, yeah, you failed to reject the null. If you fail to reject the null, that's when you're saying you believe the manager has no skill when they actually do. So these two problems are discussed. Now think for a moment, what do you think is the biggest problem? Let's say that you have made one of these two errors. What do you think is going to be the biggest problem for you? Well, guys, the type 1 error, I guess, will be the biggest problem for you because you're currently being fooled. You believe the manager can add value when actually they can't. So that's where the focus starts here. Yes, so with the type 1 error, you have rejected the null when in fact there is no value added. So you've currently hired them. You have currently hired a suboptimal manager, and you don't realize that. With a type 2 error, well, you believe that they don't add any value when in fact they do add value. And with these guys here, I guess you've not hired them. You've missed out. You've missed out on what could have been a good addition to your team here. Now we know that whenever you run a hypothesis test, there's always an error rate anyway, so you're not going to get it 100% right, but hopefully we can try and minimize these. And the slides have a few ideas how we might do that. Yes, so here we have, we've decided here to hire this guy here when they actually have no skill. That's our type 1 error. Remember guys, the word reject, I always remember here, with a type 1 error is always when you've rejected the null. And then with our type 2 error, just to summarize, is always when you fail to reject. So if you fail to reject, you're kind of accepting you think they have no skill. And here you have not hired them when in fact they do have skill. One of the ideas coming through here, for example, with these type 2 here, is to monitor. What if you were, for example, to monitor those managers you don't hire and to perhaps to review how they get on? I guess it gives them perhaps a second chance, and it gives you a second chance as well to realize perhaps you've missed out on what would have been a great addition. You can understand why type 1 errors have more of a focus. Why? Why is it important, particularly important to watch out for these? Because they're on the team. These people are hired. You've got them on the team here, and yet they're not able to add that much value. You're, I guess, currently being fooled. One of the other ideas coming in, though, is the idea of mean reversion. Just a quick mention of a slide that's coming up. We know that in level 3 and CFA as well, mean reversion, where perhaps markets reverse, and perhaps that manager that hadn't done that well previously suddenly flips into focus. Their style perhaps was out of favour. All of a sudden their style becomes very much a very useful, very lucrative way forward. So the idea that a manager will always continue to do badly or do well, we know it's very unlikely. So it's understandable here, the slide saying that the type 1 error is particularly important where on our team is currently someone perhaps that shouldn't be there. Saying here that be able to review a manager's performance compared to, say, a benchmark, that's going to be a good way to determine how they're getting on, of course. Certainly looking at past data anyway. And these managers that you've rejected in error, guys, where you've decided that they haven't got that skill, and you could well be wrong here, well, why not review them? Yeah, why not track and review these managers, even though they aren't on the payroll? Why not carry on reviewing how well they're doing, and perhaps gives you good data to come back to them later on. Now, again, a lot of places outside behavioural finance in level 3, we get mention of behavioural biases in economics and here as well. A quick reminder though here, remember there are the cognitive biases. Yeah, the errors of thinking, where you make kind of mistaken conclusions. And then also you've got the emotional biases as well. Emotional biases often hardwired to us as human beings, that the way we kind of are, what's happened to us, if it influences our view of the world. So what we're saying here, perhaps some of these decisions, you want to be careful that you aren't being quite short-term, perhaps an emotional sometimes about the way that you are making these decisions. Are you making good long-term policy decisions and not perhaps being drawn to following a trend, following the latest fad ourselves? Now, making mistakes, hiring the wrong people, hiring a Bernie Madoff could be very, very costly, particularly if you end up losing everything, of course, in terms of fraud and due diligence. You know, are fooling their money, are lucky to get together in the first place. So the idea of bringing in the wrong people could be costly, having then to get rid of them, having to end our associations and bring in someone else. It's going to take a lot more time. It's going to take away a lot of potential time and resources too. Now, one of the ideas here, which is quite interesting, is let's talk about market efficiency. Let's say that things are highly efficient. Now, in a highly efficient market, the chance to earn outsized performance is quite small. You know, the chance to earn alpha is quite small. And if that's quite small, perhaps the gap between good and bad managers is also quite small as well. And that's what they're suggesting here. The gap or dispersion between these two groups probably going to be a lot more narrower the greater the efficiency in this way. There's less scope for outperformance here. And that might then lessen the costs. Maybe the whole exercise of trying to bring in these active managers, not going to be quite as strong a case for it if the rewards are less in the first place. This thing about an outperformer here, let's have the average or mean in the middle. And let's have an underperformer here. So here is an outperformer. Maybe that's an outperforming style. Maybe we've also got here an underperformer. we know that many times the managers have a bit of luck involved. Perhaps it was a particular value style that did well, or a growth style that did well for a particular period, and that manager benefited for that period, and then things switched. And what this is giving us a bit of a warning here, it's quite likely, very likely, that at times styles, managers, factors will change. One will reverse from being the outperforming style. All of a sudden, the underperforming style will start to improve again here. So it's saying here, going to be quite tough, I guess, to time that. If you go back to the equity area and factors, guys, trying to time the factors, one of the main ideas coming in, perhaps diversify amongst the factors rather than try and time and pick the winners. It can be very tough to do that.